Good morning or good afternoon, wherever you are at. Let me know if you can hear me. The mic was muted. I was like, whoops. So if you could let me know we are good to go. And I was adjusting an order. Hello, Brenda. Let me get this moved over here. Thank you, Andrew. Well, loud. I'm gonna turn this on real quick. See if that helps or not. A little better. Well, welcome to Trading Coach's Playbook. Let's get the disclaimer out of the way before I start rambling. I'm not a registered broker dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading here. So, who's enjoying this market? Sorry if you're not. I'm not trying to boast or anything, but uh, it is crazy. It is crazy. Yeah, that's a good way to put it. So, but I'm not surprised at all. I've been expecting and planning for this for a while. Well, I mean, I've been bearish for those of you that know me, and I've been bearish for since 21, late 21, especially. And even though we were, bullish for a year and a half or 2 years, there were still a lot of bearish signs that were underlying the whole thing. So, and the cracks that were there are starting to show up. I know, the bulls and the people and, those that um, are optimists don't like to hear what I have to say, which is fine. I'm an optimist. I mean, hey, I'm super optimistic over the last 2 or 3 weeks. I mean, when your account's going up, especially when it's going up in a big way, it's pretty easy to be optimistic, even when the sky is falling, if you will. So that's kind of what we're going to talk about today. But it's uh, it's definitely interesting, and it doesn't look like it's done. I mean, just in the last half hour, as I'm sitting here prepping for this, getting ready, it's just collapsed even more. So, uh, which, as you can see, puts a smile on my face. So, anyway, if you uh, if you think I'm being negative, then just hang tight. You'll see what I'm talking about. You should already know, but some of you might be new. So here's what's coming up. Though we got Inner Circle March 10th and 17th at 7, and then the monthly one is the 13th. Mastermind Group March 11th and 18th, and Trade You March 17th. I think that's the one I'm doing. Monster Market Movers on the 19th, and then free online workshops, Power Hours every Monday at noon with Rob, and Trading Coaches Playbook. This one every Friday at noon. Futures Trading Simplified. I am assuming that's Brandon. I would imagine it would be since he's the only one who teaches futures. March 20th, 24th, 26th, and 27th. And you see the times there. So, and then every Monday and Thursday, power option plays. And then cover call explore Thursday with Trip. E-mini think tank with Brandon on Monday, Wednesday, and Thursday. So, but let's get to the topic of the hour. Well, first, you got to go find us on all the social media platforms, wherever you're at. If we haven't met, you can tell I enjoy some coffee. That's actually cup number 4, which is usually I quit at 3, but as if the adrenaline wasn't running enough already. So I don't really need another cup of coffee, but it sounded good. And the cat doesn't drink it. Lightweight. How many do you want, Steve? Mine's well, it's not super strong, but it's strong enough. So yeah, I used to drink like a whole pot. So back in the old days when I had an old pot, now I have a machine. I just push the button and gives me a good cup right there. So, um, oh, I didn't even know what you meant. I thought you were talking about coffee. It really is coffee. It's not wine. Um, yeah, it's a little early for wine for me. I'm not a huge wino, but I'll take some whiskey or scotch or a beer. But I drink wine, but it's not my favorite. So if we haven't met, there's all my. I've got a few different tools I've created over the years. So and a small accounts big return is a recorded class. It's a 2 hour class. So you're welcome to give those a test drive or go jump on them, get a subscription to them. And if you want to learn about patterns and technical analysis, patterns in Flash. If you want my analysis every week, my candidates, what I'm looking at, what I'm going to trade, or what I'm planning on watching at least for the week, that's what Weekly Whispers is. The small accounts big return is a 2 hour class I did. I don't know. I guess it's been a couple of years now. If you're working with a small account, then there are some ways to tweak and things you can do that will help give you an advantage and get you over that hump. So, oh, I tried Meet a couple of times last year. It was interesting. I just did the cheap version first, tried it just to try and see if it could even work, and it did. So I'm like, okay, I might do a little bit more. But there's a meetery in my hometown about 3 or 4 miles from my parents' house. And at Christmas time, we went back there, and my daughter and her fiance got some more. They love it. I like it, but it's not my first choice. That's actually probably one step below wine. It depends on what it is. Some of it's good, some of it's like, yeah, some of it's kind of nasty. But so if you're ever in Southern Oregon and you want some mead, there's a place well, outside of my hometown is Roseburg. It's a little tiny town and right off of I-5, about an hour south of Eugene, if you know where that's at. So if you make it up there, stop and buy some. But how many of you are afraid of a bear? Obviously, we're talking about not in the wild, but in this wild market, the bears are. I think they've completely. The bull right now is not only on its back. I think it's it's on life support. It's about ready to get its jugular just ripped apart by the bears, which maybe sounds a little gory and terrible, but you know what I mean. But the question is why? Why are you afraid of the bear? There's so many people that are freaking out about this market. And they're like, oh my gosh, they can't. They're in panic mode already. And you know what's insane that I think is insane? Hey, if you haven't studied the VIX at all, I mean, it's not something that I use a whole lot, but I look at it. It's at 2620 right now. It's only up a point 1.33 right now. Even though this market is dropping very heavy, the VIX is not in panic mode yet, which I find really, really interesting. Like, what is it going to take for them? Because about 30, if it gets to 30 or 35, and if I remember when we get back to the charts, we'll take a look at it. But 30 or 35 is kind of where it's in panic mode. It's only at 26. I mean, it's elevated, it's risen, but it's risen fairly steadily. It hasn't spiked. And usually when the market panics and freaks out, it spikes. It makes a big, quick move to the upside, and then it's over, right? It turns back over and goes back to kind of its normal little range. But yeah, even though, I mean, the Dow's off 375, almost a percentage point. The Nasdaq's down 1.5 percentage points at 268. SPX is down 65, and the Russell's down 28. Russell's down 1.5% almost, and it's not stopping. I mean, we just literally, as I'm on this monitor up here, there's I got 6 charts I'm watching, and every one of them just rolled back over again after a 5 or 10 minute reprieve, and they're heading back south. So, which doesn't hurt my feelings at all. But that is the question: why are you afraid of the bears? Because the reality is the bear markets have just as much, and actually, in my opinion, there's more potential. That's one reason I almost prefer a bear market, because not only do they usually move faster, right? Stocks sell off faster than they go up, generally speaking. And the reason for that's relatively simple, right? If you think of yourself, if you're pushing a giant boulder up a hill, it takes a lot of effort and a lot of energy to push it up the hill, right? But what do you have to do to get it to go back down? You just step out of the way. It takes no effort. It falls by its own weight. Gravity drags it south. Excuse me. In order for a stock to go higher, to move up, it takes the bulls. They have to push it up. If the bulls step away, it will fall by its own weight. It's just going to roll downhill because there's nobody there to buy it to push it higher. And just basic supply and demand. If there's no demand there, then what do? They start to lower the price in order to bring in demand. And if the demand doesn't step up and pick it up, then they keep lowering the price until demand does show up. Now, you take that and add to it, there's not just the bulls are stepping away and the boulders rolling downhill. You've got bears up top that are also pushing it. They're not just, and it's not just the bears that are pushing it, but the bulls will actually, a lot of bulls will start to sell. There's a lot of stops getting hit right now, too. Even a lot of these big money managers, you hear them on CNBC. I don't know how much you watch it. I have it running sometimes in the background here. Sometimes it's annoying. Other times it's like, yeah. But it's interesting to hear them talk about how, they've put stops in place at certain levels on these stocks. And I would imagine there's a lot of those that are getting hit right now. Because especially right now, and actually I'm just looking at this, I just noticed the Russell broke the 200-day 2.5 weeks ago or so. The NASDAQ broke it 4 days ago. Tried to get it back above it 3 days ago. And then yesterday, it failed and broke back below the 200-day again. And today it's dropping even more. The SPX closed right at, it tapped the 200-day 4 days ago, tapped it the other day after. Yesterday, it closed right on the 200-day. And today, it's breaking below it in pretty glorious fashion. Now, that's not necessarily a huge thing. The Dow is still slightly above the 200-day. I would expect the Dow to probably tap it or close on it today. I don't think it would. It's only about halfway there. It would have to be a 7 or 8 or 900 point day for it to break that. But the Dow's pretty broad though too. You've got because some of the sectors are bullish. The money's rotating out of tech for the most part, going into other places. Some of the medical stuff has been doing better recently. A lot of the food companies have had little pops. So it's not like the money completely moves out of the market. It just shifts from one pawn to the next. Some of it does go completely out, but um, I'm not sure what you mean by that, Brenda. Where no one is opening their mouth every second? To give me some clarity for me to understand that. Where people are, you mean like me talking about the Bears? Oh, politicians talking. Yeah, now here's what's going to happen. See, Trump's going to get blamed for all this. It's all his fault for the market crash, which we're not really. I mean, I guess we're in a mini crash right now. I mean, you're literally witnessing a small, it's a small crash. It's not big right now. Um, but here's getting back to the point I was trying to make is that with a bearish move, and it doesn't have to be a bear market, but just a bearish move, what you get is the volatility increase, right? So when stocks drop, like I was talking about the VIX, right? So the VIX is up. So what's happening is the fear factor is increasing, which means the market makers, the options market makers, are adding more air to the balloon of the premium that you're paying, right? The time premium that you pay on your options. They're adding more premium to that because of the fear factor. So if you get in when the volatility is low, so if you were in this market, if you were bearish before this market turned over, you probably paid a relatively small time premium. But now that the volatility has flipped and it's increasing, the volatility is going up, there's more profit, there's more time premium being pumped into your options because of that volatility, that fear factor. So you get that volatility flip when you're trading the downside, whether it's a bear market or if it's just a bear move. Even in bull markets, you'll have this, right? You'll have a big bull run, and then when it turns over and drops off, you can get that volatility flip, which is another thing that makes it challenging. If you're looking for a bounce in this market, first of all, don't try to catch a falling knife. Wait for it to give a solid signal that there is a bounce coming. But then it's also important because the volatility is increased. If you go by calls when volatility is super high or it's elevated, then number one, your rate of return is most likely going to suffer some. You probably won't make as much, and you might actually lose money. Now, Will's not here. I don't pick on him, but he learned that the hard way when what was it was a rental car company. This was a couple years ago. They were at like $80. They ran up to like 270 2 or 3 weeks before earnings. And then the day of earnings, they came out and they went ballistic. Like it went from 270 up to 520 or something like that in 45 minutes. It was nuts. I'm literally 3 weeks away from my 25-year anniversary from when I started trading. So I'm on the edge of 25 years. It's weird to say that, but it keeps like, wow. Um, But I don't think I've ever seen anything like that. And he bought puts right near the top, like timed it almost perfectly. And in the next hour or something like that, it dropped 200 points. And he lost money on that option because there was so much air put in the balloon that when things settled down and the market makers let the air back out of the balloon and the fear factor was reduced, he was upside down. 200-point move, which was 40% or something like that, and still lost money. So now that's an extreme example, but the point is, right now the volatility is increasing. If you try to buy calls right now, you're going to pay extra time premium because they're putting lots of air in that balloon, even on the call side. The whole chain will change. The time premium is going to be higher. He bought puts at the top. Yeah. Yeah, he did exactly the right thing, except buying an option. If he'd have shorted a stock, he would have made a killing because there's no time premium when you short. But he bought puts, and the implied volatility, right? The IV was so inflated, he paid so much for the options that when the air came out of the balloon, they just went. And I witnessed it myself back in '08, right at the beginning of the crash. And that's why I recognize this, and that's why I've been prepping for it for the last few months, because I expected this to come at some point. Because a lot of the similarities of '08 are starting to show up. You got the real estate market that is overvalued. It's crazy high. The stock market wasn't in a bubble back then, not necessarily. It was pretty elevated, but wasn't really in a bubble. But the real estate market was definitely inflated back then. Um, so what happened is when Lehman crashed, when that news came out, I was watching the next morning, and the spiders were going to gap down like 10 points. And that was when it was at, I don't know, 100, 150, something like that. It was I think it was an 8 or 9% drop at the open. I mean, you know what? I think the market's overreacted to this. It's too big. It's probably going to bounce. And so I remember sitting there waiting for the open, and I was watching it, and I'm looking at the calls. I have my option picked out. I'm ready to go. I'm ready to pull the trigger. And I look at this thing. I'm like, this is nuts. They were selling for like $10 when the day before they were 5 or 6. I'm like, that is crazy inflated. I mean, they put so much premium into it, and I recognized it, noticed it. I went, oh, that's crazy. I'm not going to do that. So I sat and watched it. I thought, I'm going to wait for it to settle down and see what happens. And almost the entire gap got filled within about 10 or 15 minutes. And those options, and they were in the money. The options that were $10, call options. Maybe this will help, Brenda. So I was looking at call options. I didn't end up buying them, but because I knew something, it was just off. It didn't look right. And I knew the volatility was high. The options that were $10, even though it bounced by 8 or 10 points, went down to like $8. I would have lost $2. Even though it bounced, it had a huge bounce because they put so much air in the balloon. So let's use that analogy, Brandon, because that's right. You take a balloon, blow a whole bunch of air in it. Think of that as a time value. So you've got an option where stock's at $50. The $45 call options are $5 of intrinsic value. Let's say you have $2 of time value. So you got a $7 option. The $2 is the premium that you're paying. And let's just say that volatility is normal. So $2 is a pretty normal price for a fear factor or the time value that you're paying, right? Because it's not just the time value you're paying for, it's also the implied volatility. And that's the number. The time value is pretty static. If you got 30 days to expiration, it's probably going to be, X number of, pennies per day or whatever, right? And of course, at the end, it drops off. Last 2 weeks, they start to drop off in value. But that's the time value part's fairly static. The implied volatility is the big variable. So you got $5 of intrinsic, $2 of time. Well, if fear sets in and people freak out, that $7 option, even if let's just say the stock is still at the same price, it's still at $50, but they change that $2 time premium, they bump it to $5 because of the fear. So now the option went from 7 to 10. Not because the intrinsic value changed, but because the fear factor changed, the implied volatility changed. So then they pump in this implied volatility number that says there's lots of fear here. We're freaking out. We're going to cover our butts because you got to put yourself in the option market maker's shoes. That's where they make their money. They're making their money on the spread, but they have to account for the risk that they're taking. And if it's riskier, then they put more time premium in there so they can charge more because of the fear factor, because they might lose money. And if they lose money, they want to cover their butts. So they take it from $7 to $10, even though the intrinsic value is still 5. Now, let's say the fear factor goes away within a couple of days. Stock's still at $50. There hasn't been much time value left, but that $3 of additional time premium, right? They blew air in the balloon. They put $3 of extra air in that balloon, and then the fear factor settles down, and they go, oh, well, we don't need that $3 anymore. Ooh, they let it out of the balloon. Now it's back to $7. So even though the stock didn't move, the time or the intrinsic value doesn't change, but the time value changes, the premium changes based on that implied volatility number. Does that make sense, Brendan? Did that clear it up or not? Because I know volatility is a tricky one, and trying to understand it can be hard. But okay, good. So you've got to, and that's probably the trickiest part about trading options, and that's the most dangerous part about trading options is that if you buy at the wrong time when the volatility is high, you can still lose money even though it moves. So yeah, going back to that example with Will is that yeah, he bought puts at the top and it dropped a massive amount and he still lost because he paid so much. There's so much air in the balloon that they took it back out. And the option that I don't know what he paid for it doesn't matter, but it actually went down in value. So you've got when things move big like this, I usually wait for them to settle down. I don't necessarily buy when they're moving big because the only way you're not going to get hurt in that is if it continues to move in that direction, which obviously it's been doing that the last couple of weeks. I'm surprised we haven't. I mean, we've had a couple, a day or two of little bounce here or there, but nothing significant. It's still just blitzing. Eventually, it's gonna bounce at some point. The question is when and how big, and will it sustain itself? And I don't think it's going to very long. So just depends on what level we get to. So there's a lot of variables to that, but anyway, so that's good. So be careful with volatility, especially in a market like this where we're falling. I would actually wait, and I reloaded part of a position today because the stock actually was rallying. And I was like, and it started to turn over. And I'm going, you know what? I'm going to put this back in. I took out a third of it. I reloaded the position. I already had some left. So it's, we'll see how that works out. But I don't know if that's sarcasm or not, Steve, but it's, as far as I'm concerned, it's about 40 years of neglect on every politician's part. So the markets, one person can't come in and change some things and have it immediately affect the market. You got 30 or 40 or 50 or actually probably 80 or 100 years worth of neglect and bad policy making. So from both sides. So I don't care what side you're on. It doesn't matter. There's both sides have done a lot of really stupid things. So, but yeah, I mean, people love to find blame because it's easier than taking responsibility. It just is. And that's a bad place to be if you're going to be a trader because you got to learn to own your own thing. That's exactly kind of what it's a good little segue, actually. Um, it's confirmation bias, right? If you aren't familiar with it, especially in this political environment, you'll see it everywhere. Everywhere. Here's the standard human mindset is that here's what I believe. And anything that doesn't fit inside the box of my beliefs, anything that's outside of that box, I'm not going to believe at all. I don't want to see it. I don't want to hear it. I'm not going to believe it. But if you tell me something that I want to hear, yeah, it fits inside my box. It fits inside of this right here. So therefore, I'll accept it. But anything outside of that box, no, that can't be true. My grandpa, God rest his soul, He was just like that. He believed what he believed, and you could put facts in front of his face, and he didn't care. He was not going to change his belief no matter what. It did not matter what the facts were. Agreed, Brenda. It is crazy because you could be believing a lie. But you know what? Most people would rather believe a lie than change their belief. It's easier to continue to believe something, whether it's true or not, than it is to say, you know what, I've been wrong. Most people can't admit that they were wrong. Well, not can't, they have a hard time, which I understand. I mean, nobody likes to be wrong, right? When was the last time you went out and intentionally did something wrong just because I want to be wrong, right? That's foolish. We don't do that. And we all want to be right. And admitting that you're wrong is not easy. And especially when you have, hardcore, hard held beliefs for whatever reason, whether they're right or wrong doesn't matter. You're going to believe them. For the number one purpose is to protect the human ego. Because who wants to say I was wrong? I screwed up. Or I wasn't, my belief has been wrong this whole time. I believed it for 15 years. But now here's facts that disprove it. You know what I mean? So we all naturally look for information that confirms what we want to believe. And in the trading world, that will absolutely destroy you in the long term. I just saw your note trip. Sell more, remember sell. Um, so yeah, I mean, if you're going to be a trader and you're going to succeed long term, you have to not only learn to recognize your own confirmation bias, but you have to fight against it. I want to say terminate it, but you're not going to terminate it. It's there naturally. We are naturally, we protect ourselves and we protect our egos. That's the default position that pretty much that every human's in. So you've got to work to fight against the confirmation bias and learn to recognize, because if you can't see reality in the market, if you can't see the truth, and that's part of what I mean, part of the concept of today is that you've got to see the bear coming. You've got to know that the bulls are getting tired and the bears are coming up going, hey, we're going to take over this thing. So yeah, well, admitting you're wrong about little stuff is pretty easy. It's the big things that are hard. It's the long held beliefs that you've had about X, Y, and Z, and realizing that, you know what, I've been on the wrong side. And, there's a lot of people in this last election, and again, not trying to get political, but there's a lot of people that realize that I was on the wrong side of things. And it's partly because one side of the equation has decided to go full out insane and literally promote falsehoods. I mean, you're entitled to believe whatever you want on subjective matters. But when there's objective things, yeah, that becomes a problem. I mean, you want to be Peter Pan? Have at it. But not in my world. You can believe anything you want. Like I said, if they're subjective. But I mean, one side went so far off the deep end, it made them real, made the others, made the people that were normal, like in the middle, they all like, that stuff's over there is crazy. Right? So, I mean, and it is what it is. Again, not trying to get political, but it's just it's also something that, it can to a certain degree affect the overall markets. I mean, obviously politics does. The policy that's enacted has an effect. But like I said, you've got at least 40, if not 100 years of bad policy making. Some good, but most of it bad. So not sure exactly what you mean by that, Steve, but I mean, that's just I mean, there's just such a mess all over the place, and the world's. I think the world went mad for a short time, and it's starting to come back to its senses. If you look at the big picture, um, I think like I said, the pendulum swings. And I met a gentleman, I don't know, this is 6 or 7 years ago. He was actually a federal judge. He was appointed by Jimmy Carter. The guy was 88 years old or something like that. We ended up having a conversation, and he was a super cool guy. Um, and he was a liberal. And he goes, all my friends are this or that, and they're freaking out about Trump. This is back in Trump's first term, and they're freaking out about him. They're like, they're losing their minds. He goes, just chill out, people. I mean, and he's seen how many, I mean, probably a dozen or so of these cycles. He goes, just relax. If the pendulum swings one way and then eventually it comes back the other way, it almost always ends up back in the middle at some point. And I think one side went so far, they swung the pendulum so far out to the left that now it's swinging back to the right and they're freaking out because they think the world's coming to an end. It was really interesting to hear that from him because he's, like I said, he's been around for a long time. So, and he was obviously very political. Uh, but yeah, I mean, that should be pretty obvious what's on the screen right there in front of you. Or might be witnessing the beginning of a bear market, which I think we are. I think this is leg one. Uh, I mean, unless if it just keeps falling for another 2 or 3 weeks, well, yeah, that's hard to say, but I would expect it to bounce here any day. I mean, maybe not today because it's Friday over the weekend. Oh, that's right. He is talking today, huh? Did he just start? Oh yeah, the market's bounced a little bit. Probably somebody anticipating that. Okay, yeah, I thought I remember that at 12:30. Yeah, give it 20 or 30 minutes. It'll probably roll back over. Maybe he'll say something that the market likes though. So yeah, you never know. Yeah, the whole Ukraine thing's a mess. And I've got a guy I know. He doesn't live there, and he moved out right before the war started, actually. So thankfully, I mean, he had a little kid. He's like, yeah, Trump and Powell are talking to. Well, I appreciate that you're all sitting here listening to me. Where does that put me? Oh, Trump's 11, Powell's 12:30. Trump again at 3. So anyway, I said this. I don't know if it was in here or if it was in Trading You. I can't remember where I said it, but I was talking about um, where to be in your trading right now. Okay. And I've been on the bearish side of things for 2 or 3 years, like I said. And a lot of people are like, well, there's this goofball on Facebook. He and I get into it sometimes. And um, speaking of confirmation bias, there's a perfect one. This is a guy who literally is spouting off and putting stuff into that are factually false, like data, objective facts that are proven with data. I said, first of all, use some common sense. That's all you have to do to recognize that this myth is a total myth. There's the old myth that 80 or 90% of options expire worthless. It's an abject myth. And I've been on a quest to destroy it since 2005. Just use a little common sense and look at an options chain. No matter where that stock closes, half the calls and half the puts are out of the money, and half are in the money. Doesn't matter where on the chain it closes. So it doesn't make any sense that 80% or 90% could expire worthless when it's 50-50 at the end of the month at expiration day. But there's actually data because when I read that about the myth in Larry McMillan's book back in, well, I reread it in 2005 or 2006. I actually emailed him. I got on his website and emailed him and I said, hey, do you have any data? Because you said in your book that you don't back up. The CBO wouldn't give you their data. He actually emailed me back. And he said, I kept data for about 4.5 or 5 years just to try to confirm what they had told me about how many options expired in the money, out of the money. And he sent me the spreadsheet. I kept it. I still have it. And I literally posted it. It's actually, the truth is that about, I think it was 56 or 54% of options. I have to go pull it up. I don't know where it's at. 54 or 56% of options expire with value. And then they estimate that about 10% are closed out at expiration. So they had some value at least. So it's actually more than 50% have value at expiration. So this dumb myth that 80 or 90% of options expire worthless, it's just that. It's a myth. It doesn't even pass the common sense test. And I posted that for this guy. I said, here's the facts. Go read McMillan's book that he wrote 20 or 25 years ago, 30 years ago, probably. And here's the data that he himself sent me, proving that you're wrong. And he wouldn't believe it. He still was like, I don't know what he said, but it was just like, that's not right. It's insane. It's insane to believe stuff like that. I was just like crazy. But the reason I'm on a mission for that is because I had a gentleman, this is where it came up, showed up to a workshop. Macmillan on Options, I think it was. He's got two big books that were out. I think that was the first one he wrote was Macmillan on Options. And then there was his other one, I think, is Strategic Options Investments or something like that. Look up Larry McMillan, you'll see. But I'm pretty sure it's Macmillan on Options is the one that I had. It's been 25 years, almost 25 years since I read those. But what's funny is in 2005 or 2006, we were at a one of the free preview workshops, live workshops, because back in the day we didn't have this. And a gentleman shows up for the first one, and he really wanted to go to the 2-day workshop. He really wanted to pay for it and go, but he finally told me he had a car accident like 25 years before, so he couldn't think. I mean, he had just recently got to a point where he felt like he could make good decisions on his own. He had a brain damage, and he was well aware of it, and so he was cautious about how he did things. So he brought his friend back that night. And I ended up having a conversation after the preview with a friend, and we sat down, and he asked me, one of the first things he asked me, he goes, true or false? 80 or 90% of options expire worthless. And I said, false. Oh, he freaks out. Gene, we got to get the hell out of these guys don't know what they're talking about. And the funny thing is I happened to have that book with me, and I just started rereading it, and I was highlighting stuff on the plane on the way there. And I just highlighted that spot in there where he says it's a myth. And so I just very calmly asked this guy, you ever heard of Larry McMillan? He goes, no, who's that? I go, well, he's pretty much the options guru. He's been trading since 1972, since listed options came out. On page 21 of his book, he talks about this as being a myth. Would you like to see it? Because I just happen to have it with me. And he goes, okay. So I go grab the book. I open up to page 21. See page 21. There it is highlighted. This is a myth. and and he just sat there just like he was just stunned. He's like, and later Gene told me, he goes, he had nothing to say because he felt like an idiot because he spent like 15 or 20 grand going to a workshop with this other company that taught him to sell naked puts based on this myth that 80 to 90% of options expired worthless. So the odds were on your side. If 80 or 90% expire worthless, then all you have to do is sell one, and the odds are 80 or 90%. Yours is going to expire worthless, when that's not even true. The sad reality is there's lots of people out there that have taught that kind of stuff. They perpetuate the myth, and they promote certain strategies based on that myth, which puts people in an awful position. If you don't know any better and you believe it, then you go into these strategies and you get cleaned out. Because I guarantee you right now, anybody that sold puts in the last 2 or 3 weeks is getting absolutely destroyed right now. They're getting their heads handed to them. And if they're the ones that bought this myth, what are they thinking right now? You're getting assigned a whole bunch of stock. You know what? Just about everybody I know, all the coaches I had when I started in 2000, the ones that got cleaned out, they got cleaned out because of naked puts. They sold naked puts because that's what they were making tons of money on the way up. And then when the market turned, they had never seen a bear before. They didn't know what a bear looked like. They'd never experienced a bear. And the bear not only ate their lunch, but it went to their freezer and ate everything in their freezer. So listen to as many people as you can, but be careful what you take as gospel, if you will. I tell people, don't take what I say as gospel. I'm not right that often. But see, trading is not about being right. It's not about picking the right direction or picking the right stock. It's about putting the odds on your side and managing your mindset. Those are the two most important parts of trading. Putting the odds on your side and managing your head. The difference between successful traders and unsuccessful traders is right here. It's between your ears. It's about managing that well. And it ain't easy. It's hard. And that's one of the reasons I bring up the confirmation bias, because it's easy to get caught in that trap. So many people do. I get caught in this sometimes. That's why I say don't terminate it. It's like people say trade without emotion. It's not possible. That's like saying live without emotion, be married without emotion, have a relationship with somebody without any emotion ever coming in. Don't ever get upset or angry with somebody. I mean, it's ridiculous. We have emotion. That's the way God created us. And if you fight against it, it's deadly. I'll never forget as a kid, we went to this swimming hole at the river. It was a river forks, right? Where one main river came down here and it split and went this way. And we were always told, and I think it was more fear than anything, that there was an undertow over here. In the one on the one side, there was a big old rock there we used to jump off of and swim in. And we were always told there's an undertow. And they always, my parents always said, if you get caught in an undertow, you swim with the current, especially in a river, right? You get caught in an ocean, that's deadly, that's bad. But in the river, it eventually stops, right? It eventually ends. So swim with it, and eventually it'll stop when you can get out of it. I've never been caught in one, but thankfully, but I was always prepared mentally to do that if needed. So right now the market has turned decidedly bearish. So if you're bullish, then shift your bias to the bearish side. Unless we turn around, which at this point, with the momentum and acceleration that we've had and the velocity we've had on this downward move in the last couple of weeks, there's going to have to be a lot of evidence for me to believe that we're going to take another leg to the upside. I think short time we'll have a bounce, obviously, at some point, but I won't believe it unless it's, if we get a solid support level that establishes itself, well, maybe a double bottom, maybe an inverted head and shoulders, but I don't think that's like a double bottom might happen. Inverted head and shoulders, I don't think would happen this early. But um, that's weird, Jennifer. Yeah, sorry, that stinks. But well, I guess the good thing is you can go back to because this will be posted on YouTube, I believe. I don't know. It's usually a day or two or maybe a week or so before it goes up there, but you can go back and watch it on YouTube. And then you can speed it up since I don't talk fast enough already. What if Powell cuts rates? I think that would actually probably freak the market out. That's a weird thing. You never know how the market's going to react to certain types of news. And that they've been talking about that now. Just last week, they started talking about, well, they're cutting rates because the market's dropping. The market hasn't even, I don't know what percentage is down. It's pretty close to 20%, which is bear territory. But to be talking about rate cuts because of a sizable dip in the market, I think it's foolish myself. You can't. Well, there's the thing. If Powell has to cut rates, then he knows something. That's my opinion. If he knows something more, the deeper stuff, which is what I believe. I believe the economy is terrible, but so is inflation. It looks like we're headed for stagflation, which is bad. It's inflation and a weak economy. And as far as I'm concerned, we're in that. I think we're probably already in a recession. If we're not in one right now, we will be in one soon enough. So, but that's just my opinion, and I've been wrong many times. So, you got to form your own opinion, obviously. But yeah, I think Powell cutting rates would indicate because inflation's still high. In fact, it's been ticking up the last few months. So he should have raised rates more. He shouldn't have stopped raising rates. He should have continued to raise rates. Is what he should have done, in my opinion. Because the inflation wasn't done. They were trying to get ahead of it, though. That's the crazy thing is that they're always late to the party when they need to raise rates. They should have raised rates probably 6 or 8 months before they did, but they waited until it was too late, and then things were bad. And then instead of waiting until things actually stabilize, they tried to get ahead of inflation getting too low. With inflation too low, that's fine. Generally speaking, I think they're trying to avoid deflation because deflation is not good either. Right? That's what China's experiencing is deflation. Or at least they were a few months ago. So Apple is, it's up $4. But remember here's the thing, in bear markets like this, these kinds of bounces like we're seeing right now, NVIDIA just bounced 2.5 points in the last 20 minutes. You got to remember, put yourself in the shoes of a short seller. If you've been short in this market for the last couple of weeks, or if you were short before it dropped, what are you going to do? You're going to start taking profits. So in bear markets, you get these pretty violent upswings because people are taking short sellers are taking their profits. And then you've also got the longs coming in trying to pick the bottom. We don't know if it's the bottom yet. It might be. But longs will come in and buy because they think, oh, this drop is over. And so they start to buy. And then what happens is the shorts will have their stops hit. So it creates this massive velocity to the upside because you got buyers coming in buying the dip. And then you got the short covers also coming in. So it makes it look like we're done bouncing when in reality, it's just a short covering rally. If this turns into a full-fledged bear market for the next few months or a year or two, that's one of the challenging parts to trading the downside is you get these large whipsaws. Scaling is one of those things that works beautifully for that. It's kind of exactly what I did with this one trade. Got into it, I don't know, a week ago. Sold a third, put an order out for a third of it at this, one target with 20 or 30 or 40% rate of return. It got hit on it the other day and it bounced over the last 3 days. I just reloaded it today as it started to sell off. So if it rolls back down like I expect it to, then now I'm back in the position. I banked some profit on it, so I'm in good shape. Unless it keeps bouncing. If it keeps going up, then I'm getting beat up a little bit. But I already banked some profit on it, so not a big deal. But the question becomes for this is if you own stock, I know I just saw that. That's what I was looking for because I always go long. Um, how do you protect your longs? If you own stock, if you have a portfolio of stock, there's a couple of different ways you can do it. If you swing trade, you're in and out in 1 to 7 days. When they rally, when the long stocks you own rally, and it looks like they're rolling over and going to head back down, you could sell some in the money calls, covered calls, right? You do covered calls, but they're slightly in the money. So that if it drops back down, you're not only collecting that intrinsic value and the time value that's there, you're collecting more on your covered calls instead of selling out of the money, right? The challenge to this, the one thing you want to make sure of if you do that is make sure that there is some time premium in the options. If you sell so deep in the money, there's no time premium, they might get exercised, which technically wouldn't be that big of a deal. You can just do an SDS, same day substitution. So if you get a call from your broker, hey, you sold those calls against that stock in the money, it just got taken away from you, just tell them do an SDS, same day substitution. So you're selling it, you go buy it back right away, and so it washes itself out. It might cost a little bit, but if you're going to employ that strategy, first of all, know what you're doing. That should be said for anything. Second of all, you want to make sure that you've got some time. If they have some time premium, preferably more, then the odds of them exercising are very, very slim. I actually think on a long-term portfolio, this is not a bad time to do a long-term caller. Maybe go out to January of 26, sell some out of the money calls, buy some puts. And that's the hard part is when to do that. Right now, it's beat down so bad. If we get a rally out of it, I would wait for a little bit of a rally in a stock. Depends on what stock you're talking about, right? In fact, let's get through this to go look at one. So we have about 10 minutes. There's the last one. Lean into the bear. Get a hug. Bears have good hugs, right? They're fluffy. Bulls, not so much. They have a little short hair. It's really rough. It's like, eh. But bears, I've never hugged a real bear. But I've touched a bear. I have some friends that are hunters, right? So they have bear, what do they call them? Pelts? Whatever they are. I don't know what they're called. I'm not a hunter, so bears hug better than bulls. So let's use Amazon. For some reason that came into mind. So let's say you own Amazon stock. And obviously you're not too thrilled right now because it just dropped basically 50 points in the last 2 or 3 weeks, which is 20%, essentially. The question is, what are you going to do if it gets all the way back down here to 80 or 90 or 100? So let me see. Pull an option chain real quick. See if I can pop it down here. Where's my detach? There it is. There we go. Amazon. They put Downy on their fur? Really? Is that real? Or are you joking? I wouldn't be surprised. I imagine they wash it at least. If you're going to hang it in your house or put it on your floor. So let's go January of 26. Let me move that to the left here, actually, so we can see the chart while we're looking at it. January of 26. So let's just say you own Amazon and you are, I mean, it's been beat down. So I would, well, that's the hard part is not knowing how far. I mean, it might drop to 180, 185, and then it bounces back up to, it's going to bounce at some point. The question is, how far does it fall before it bounces? And how much are you willing to take that risk? And that's obviously a decision only you can make. But for example's sake, let's say, okay, you'd be happy. And this is, so yeah, this is January of 26. So it's, what was that, 10 months? So if you're expecting 25 to be bearish, which I am, if you sell the 230s, so between now and the end of the year, you get out at 230 if it goes back up. If you're be happy with that price, selling it, if it does turn around, go back up and rise, and 25 turns out to be a big bull market, 14 bucks, you can come down and take that exact same 14 bucks that you sold it for and buy either one, the 180s or 175s. You know, you could bank $100 of profit if you buy the 175s. Obviously, you have to have lots of 100 shares, right? But that protects you anything below 175 between now and January. So let's just say here's where I think it gets fun, especially if you have a long-term buy and hold portfolio. This is where I think this is spectacular. Say it does drop all the way to 100. I'm going to use 100 to keep the math easy. You got the $175 puts that you technically didn't pay anything for because you sold the 230s for 14 bucks. You bought the 175s, didn't cost you anything. You actually put $1.50 in your pocket. Um, make the chart bigger. You talking about the chart or the options? The options chain I can't make bigger. Or let's see, can I make the? I don't think I can. Can I change the size of this? The text? I don't know if I don't know how to change the size of text in this thing. I never have. But I'm trying to have the chart on the right hand side so you can see the numbers and then the option chain. If you want the option chain numbers, you'll just have to believe me. So the 230 calls are selling for 14 bucks. The 175 puts are 12.35, called 12.50. So you bank $1.50, which isn't a big deal. But anything below 175, you can exercise it and sell it at 175. Or if it comes down to 100, you got 75 bucks of profit. If you sell that option, okay, because if you like Amazon for the long term and you want to own the stock for the long term, you don't have 75 bucks of profit because you sold the calls to fund the purchase of puts. So you don't have any money out of pocket. You got 75 bucks of profit. The stock's at 100 bucks. You sell that 75. Now you don't have to pay 100. You're not technically paying it. I mean, I guess you are. You're paying 100 bucks for the stock, but you got 75 bucks of profit from your puts. So you really only have to bring $25 into the transaction to go buy more. So if you want to buy, let's just say you have 100 shares. Um, yeah, I don't see anything there. Anyway, that's the thing. I understand y'all want to see it, and I get it, but just go with me conceptually here, because that's really what I'm talking about. The numbers, the details of that aren't that big of a deal. So you funded this put by selling the call. And I think the odds of Amazon being above 230 by the end of this year, probably pretty slim, especially with what's going on right now. Maybe I'm wrong, but if you're content selling it at 240, and you can change the numbers, you can go out. I'm just pulling those because that's what's here. But go with the concept here. I sell those, collect the cash. I buy an insurance policy at 175. It's now at 100 bucks. I have $75 of profit in that put option. I want to buy more. I had 100 shares. Now, instead of having to come with $10,000 to the table out of my pocket to pay for those 100 shares of Amazon and doubling my position, I only have to come out of pocket with 25 bucks because I have $75 of profit there from the put, the insurance policy I bought. So I can sell those for 75 bucks, put 2,500 into my account, buy another 100 shares of Amazon. I just doubled my position for a quarter of the cost simply by employing a simple collar strategy. So if you want to be a long-term holder of stock, it would make sense to do something like that, especially considering that the upside of the market is not that spectacular, considering that even though I'm not a fundamentalist, I watch quite a bit of news, and even guys that aren't necessarily, they're not mainstream media, but they're not traders, they're long-term investors, they're talking about the market being overvalued. PE ratio of the Dow is like 26 or 28 or something like that. The S&P PE ratio of the overall market is in the same range, around 30, when the historical average is around 16. When you look at the fact that Buffett sold a huge percentage of his portfolio, he's got the largest stash of cash historically in Berkshire's ever, 380 billion or something like that. He's been selling out for 6 months or a year because he understands he's a valuation guy, and he looks at the market and goes, "This market's crazy overvalued. I don't want to be in it." That's where Buffett excels. He recognizes that when the euphoria is there and the market is overvalued, you get out of the way. So even though he's not 100% out of the way, he has positions on still. He's got a huge stash of cash. So when it does correct, because it's going to correct, it already has, obviously. The question is how far and how fast does it correct? But when it does get down to a place where the valuation is more in his area, he'll take that, he'll back up the truck and just dump all that cash in the market at one time. That's exactly what he did in 08. He got out of the market like 06 or 07. He stayed out of the tech bubble because he didn't understand it. He goes, "I don't understand it. It's not in my wheelhouse. I don't trade like that." And so many people were making fun of him in the late 90s. It's like, "Oh, you're losing billions and what an idiot." Then the market crashed and most of those people calling him an idiot went bust and he got richer. And in 08, when the crash happened, he backed up the truck. He had a ton of cash on hold. He backed up the truck and loaded up. That's what he does. He recognizes when the overall market or even an individual stock is overvalued and is too high. And he gets out of the way. And then he waits till there's blood in the streets. And when people panic and they're freaking out, that's when he buys. He's mastered that. And that's what's made him a billionaire. So why not emulate that, right? And who knows what's going to happen. The beauty is, and there's some people, I just heard a guy say it the other day, is that Buffett doesn't trade options. That's not true. Go look up his 10Q. He actually, I think it was Occidental Petroleum, or was it the railway? What was the railway that he bought back in 08 because it crashed? He bought the whole thing, right? It was Burlington Northern, I think it was. He had sold a ton of puts below the stock and collected the cash. I mean, you understand, Buffett owns Progressive, Geico. He owns insurance companies, so he understands insurance. And I'm sure he understands options, so he understands how they work. And he knows that if you sell it, he sold it at like $80 or something. And the stock dipped down to 60 or something like that. So he ended up being forced to buy it, but he wanted to buy it anyway. And yeah, getting it at a bargain baby, it ended up doubling like 2 or 3 years later. It was worth twice. I mean, the valuation went twice as much as it was originally. So he killed it. Yeah, buying wholesale with puts. The question becomes, when is wholesale? Because there's a lot of people now. I had a little time to kill this morning. I'm just kind of watching some trades and stuff, but I get on Facebook and tool around some of these trading groups, and they're like, "Oh," and these people are trying to pick the bottom. They're looking for a bottom right here. And I'm like, I get it because I used to be there. I was looking for a bottom in 2000 when I started because I didn't recognize we were in a bear market because I had just started. I had no idea what a bear market was. And none of my coaches did either. They were all trying to pick the bottom. So I got destroyed because I had no idea what I was doing. But I learned to recognize the bear. And in 08, I did fairly well when it crashed. And now I have that experience under my belt. And this time I am much more prepared than I was then. There's opportunity everywhere. Whether it's bull market, bear market, doesn't matter. That is the beauty of trading and knowing how to leverage and utilize options in a wise way to improve your rate of return dramatically, right? They're a form of leverage, but in this case, they can be a killer form of protection and leverage. Because in this case, you're protecting your downside, but you're also giving yourself leverage so that if it does crash, you can turn that cash that you converted into profit, you can turn that into buying it when it's down at a low price. And then if it goes up over the long term, then obviously you've got twice as much of a position. So, um, where was I going with that? I don't remember, but Jennifer, I believe they should post it on YouTube. I'm just not sure how long. It seems like it's a day or two before it gets up there. Sometime maybe a week or two. I don't pay that close attention. I mean, I get notified anything Wealth Builders HQ that goes on YouTube. I get a YouTube notification. Um, yeah, and you're normal, Jennifer. Don't feel bad. I mean, she said, I kept thinking it'll go higher. And that's the thing. Here's probably the best piece of advice you can give is watch your own emotions. Pay attention to what you're feeling. And if you're in that place where you think it's just going to keep going forever, that's a clue that the end is near, right? Because that's what in a euphoric, and that's what Buffett sees. That's what Buffett has learned to recognize over the years. And the guy's what, 90, 92 years old. So he's got a little experience. Is that when the market and people, you watch the news and you read news stories and you see the stuff, when people are euphoric and they think they keep talking about like this is going to keep going. This is a bull market. We're in a great bull market. It's never going to end. It's going to keep going. That is the end. And the inverse of that is true is when everybody starts talking, when all the media outlets start talking about, oh gosh, this bear market, oh my God, and everybody starts bailing. Your average Joe at the water cooler that has no idea about the markets, when they start selling and they're freaking out because they're losing their shirts, and we're talking, lots of them, not just one or two people, but when the mainstream, when your average Joe starts to sell, that's the time to load up the truck. Buffett learned that a long time ago, and that's the strategy he's employed. That's why he's out of this market right now. I mean, not 100%, but because he knows the euphoria, he can see it, and all you have to do is pay attention a little bit. There's this euphoric thing. Pay attention a little bit of the macro picture. What's the real estate market doing? Real estate market is on the edge of possibly collapsing. There's tons of loan mods that have been taking place for the last 6 months to a year. If you don't know what a loan mod is, a lot of it happened in 2020 because people got behind. They couldn't pay their mortgage, right? They weren't working. So the lender takes the amount they're behind and tacks it on to the end of the loan and basically restarts it from there. And in the last 6 months to a year, there's been a lot of those, and they're accelerating this year. So people are in trouble financially and can't make their mortgage. That's not a good sign for the real estate market. Interest rates are still elevated. And the Fed's fund rate, if you haven't figured out, is not directly correlated to the mortgage rates. Mortgage rates are based off the 10-year treasury, the 10-year note, 10-year bonds. And those are based on risk, based on the bond market, what the bond market perceives as how much risk is there in this mortgage. And that's why, even though the Fed cut by a point, mortgage rates went up by a point. People think that it's the Fed if the Fed cuts, then that'll help mortgage rates. No, it won't. It might. It's indirectly correlated, so it can, but it's not a direct correlation. So you got to recognize that too. And houses are they're unaffordable. And when the economy starts to crack like it has been, and employment's starting to go up, unemployment, I should say, that's just going to accelerate that move. Now, I don't know that we're going to have a crash. It might just be an orderly decline. But if there's any black swan shows up, like if a big bank fails, that's going to send the market into a tailspin as far as I'm concerned. And I'm expecting a bank, if not several banks, to fail because commercial real estate is in the tank. Residential real estate hasn't happened yet, but it's getting close, right? It's getting close to the edge of the waterfall. And at some point, once you crest that edge and, you know, the proverbial stuff hits the fan, it's bye bye birdie. And then things get ugly. Another reason that because I pay attention to all this macro stuff and it's like, what's going on with real estate? What's going on with this? What's this? And that's why I am predominantly trading bearish right now because I think the odds of a crash, either a major correction or a crash, are higher than this thing continuing to run higher to be in a bull trend. Um, well, yeah, I mean, Jennifer, there's a lot of factors involved when you're thinking about selling. I know I'm over. Sorry, Andrew. I mean, obviously there's can be tax implications. I don't know what your situation is or what it is, but um, and you don't necessarily need to sell. It's like I said, you can you can sell, like I said before. I don't know if you were here. I know you had problems getting in and out, but you could sell in the money. You could treat them as a swing trade, right? And sell in the money calls and collect when it bounces up a little bit and then it starts to roll over. Sell in the money calls. If it drops down, like we'll take Amazon for example. Let's just look at this. Let's say it okay, it bounced up here. We'll just take these 2 days. I can zoom that way in. I'm trying to hustle here because I got to shut up. uh, so let's say it bounces here in these 2 days. And you look at it, and go, okay, I think it's probably going to fall back again. It's at $210. If you sell the 200s, you sell the $200 calls up here. It's at 210. You're getting at least $10 for it. You're probably you should get 12 or $15 for it. You get 12 or $15 for it. It drops down here to $200. If you got 12 bucks for it, it drops down here $2. It's probably going for $5 or $6. So you sold it for 12, you buy it back for 6, you banked $6, right? And you get out, and then if it bounces again, then do it again. So you could do that when stocks are falling like this. You could do something like that, right? When it bounces up, and obviously it's I'm picking these as an example, but I mean if this thing bounced like this and you see it right here and you go, I don't expect it to go much higher. I'm going to sell the 215s, but you have to treat it like a swing trade and say, okay, I'm going to sell it here. Obviously, you're not going to catch them very high. But let's say you just sell it here as it's falling back at 215. 2 or 3 days later, it's 205. That's 10 points. You're probably going to get 5 to 7 points out of that. So you can capture in just a day or 2 or 3 days. If it falls, you can capture 5 to 7 points. But what's important to do also is, okay, I'm going to sell it here, but if it goes here and the stock goes up, I need to stop out. So you treat it just like a regular swing trade where you're going long an option, where you're buying or selling a call or a put, but you're doing a covered call. So it's essentially just like going long, but the opposite. Hopefully that makes sense. So that's just an idea. But yeah, I think the caller idea is probably a better one if you don't want to babysit it constantly. If you want to protect your downside, and actually Amazon was a good example because I don't know that it's going to be above 230 at the end of the year. And I would expect it to actually go to 100 before I expect it to go to 230. But that's just me. I mean, the last earnings calls have been said, things are getting weaker. A lot of companies have done that. The retail environment is getting weak. So, I mean, you really just have to look at it and figure out how much do I want to leave at risk? And if I don't want to leave it at risk, how can I protect it? And you got to figure out a strategy and a way to do that makes sense. Tom, I cannot. I don't have any actually on the radar. I don't know any specific names of banks that might fail, but let's just say that the commercial paper they have, right? The loans they have out on commercial buildings is likely underwater. And if you look at that data, most of the real estate holdings are underwater. The last couple of years, real estate valuations have either stayed stagnant or dropped off. There's certain pockets of the country they've dropped 20 and 30%. Florida, Arizona, Vegas, they're like down 20 or 30%. And the inventory of houses for sale has increased in some cities, and it's spiked. It's gone up. It's literally at like 10 or 15 or 20-year highs. Some areas are higher than 2008. So the inventory, the supply of housing is going higher. And that's the other thing you got to keep in mind is these new builds. They're building new houses, but those aren't on the MLS. So the inventory numbers you see, what people keep saying, oh, low inventory keeps the prices high. But those new houses are not in the inventory numbers. And I don't know where you guys are at, but around here, there's a lot of condos, a lot of townhouses, a lot of new apartments have gone up, lots of new houses have gone up. Just, I mean, in a 5-mile radius of me, I see when I get out and about, there's little buildings going all over. But if real estate, a lot of these banks are so leveraged up with loans that if the real estate market corrects by 20%, their paper's underwater, which makes them essentially insolvent. So yeah, I mean, it's definitely when you pay attention to it and you see what's going on behind the scenes underneath the surface, it's like that's part of the reason we're just starting. I think this is just the beginning This is the first leg of a bear market that could last for some time. How long? I don't know. How fast it goes? How do I know? Honestly, Tom, a lot of it's on YouTube. Go look up. There's a lot of guys on YouTube that have a lot of good information. There's one guy that he created an app called a Reventure app. I can't remember his name. Peter Schiff has a great macro V. He's a big gold guy, right? He's got a fund that he runs. It's a gold fund. Um, but he predicted the '08 housing crash. He predicted something else too. He's made some pretty big predictions, and he's ahead of it. He's usually and usually when you're making predictions like that, it's you're ahead of the market. I've been expecting a crash for a couple of years now, and if you go back and watch Michael Burry, what's the Big Short? He was starting to do those contracts in '06 and '07, and the market finally crashed in '08. So a lot of it's just paying attention. Yeah, get on YouTube and start poking around looking for, how's the real estate market? Or there's another guy that does, he's got a podcast he does on YouTube that's, I just watched it the other day. And he has guests on, they do interviews. There's quite a few of them out there, but you'll find ones that you like. But the big thing to do is make sure you're not going back to the confirmation bias, is make sure you're not just looking for information that you like to hear. Find information that challenges what you believe and opens your eyes to the possibility that, you know what, so yeah, it's when you start to look at when you dig deeper into it, you start to see all the underlying things that are going on. And like I said, if one big bank fails, that's what happened in '08, right? Lehman failed, and that's when the market just fell off a cliff. It was already headed south, which is part of what caused the Lehman collapse. Is because when they get heavily leveraged, which banks are very heavily leveraged, the question is what's going to happen? Is the government going to bail them out or not? And I'm not sure that this one will, which isn't a bad thing. I mean, it sucks. It's terrible if you lose your money. But part of the reason that we have the boom and bust cycles that we have now is because the government's in trying to protect everybody. The government is manipulating things. The data that we've had over the last year or two, and that's the thing, all the growth, all this supposed growth, the reason the market's been in a bull market is all the federal spending. You got $2 trillion of deficit and a 36, almost $37 trillion debt. We're paying $1 trillion a year in interest. If you did that in your personal finance, if 15 or 20% of your budget was going just to pay interest, and you continue to run that deficit, eventually you're going to go bankrupt. That's the path this country's on. As I say, I'm not blaming one side or the other. It's 40, 50, 60, even 80 years of bad management and bad voting, quite frankly. I mean, it's ultimately our fault as the people for voting in these morons that don't manage money properly. And part of the reason is that everybody wants to be bailed out. Everybody wants the government to back them up. And the banks have FDIC and all this. In the old days, this is one argument. Sorry, this is one argument Peter Schiff made. He goes, in the old days, before FDIC and all this insured bank stuff, guess what you did? You went into the bank and you sat down and said, I want to see your books. I want to know that you're a stable bank so my money is safe. You had to do your own research. Now nobody cares. Just put it in the bank because it's insured by the government. But if you've ever been through one of those, and I know I haven't thankfully experienced it, but I know people that have, and getting your money out from FDIC can take a long time. Honestly, I wish the government would get out of most of the things they do because they're the ones causing the problems. They're not helping things. They're not making things better. They're making it worse. They've created this bubble, and then they're going to come in and try to be the savior when the bubble pops. It's ludicrous, but that's just my view. So yes, it is all over the place, and that's going to continue for a while. Um, that's the hard part, Brenda. Find information that's true, not what you believe. What is true? That's the hard part these days. Is finding information that's accurate. So, I mean, if you look at the right spots, but that is can be hard. So it's challenging. That's the hard part, and that's why there's so much divisiveness. There's just so much information out there now, and it's hard to figure out what's what and what's true and what's not. So people believe a whole bunch of fallacies and things that aren't true, and then those of us that know that they're fallacies, like that's not true, they freak out and they're like, oh yeah, it is, whatever. Um, That's a good point, Barry. I'm glad you said that. And um, I'm gonna wrap with this, Andrew. Sorry. He said that the 0809 crash took 16 months. And the 2000 crash, I think, was 18 or somewhere around that as well. The COVID crash took 6 weeks, which is something I've talked about actually for several years now, is that in 08, we weren't as technological as we are now. People have phones in their hand and can place orders. Back then, it was internet trading was pretty bad. I think 25 or 30%, if I remember right, seeing the stat, were trading online. Now it's something like 70, 80, 90%. And when you add into that, you've got the boomer generation who the second half have started to retire in the last 2 or 3 or 4 years. And their money's tied up in equity. Most of their wealth is tied up in equities. And what happens when they start to look at this? I guarantee you, a lot of them right now that have just recently retired in the last year or two, and then this next month's statement, they're going to be like, what happened? My portfolio is down 20%. They're going to be calling their brokers. Brokers are going to be busy trying to talk them off a ledge. And they'll probably talk them off a ledge. Some of them, I think the wiser ones will probably sell if they understand the markets of a value. They'll get out of it. But a lot of them are going to be like freaking out because they see their retirement account down 20%. They're going to be like, because they haven't seen it, right? They haven't experienced it, especially now that their mindset is different and I'm retired and I can't go out and make money. What's going to happen when the boomers start to, I mean, and it's something I saw this recently too. There's like 60% of the market, 60% of the investments in the stock market are held by baby boomers. If they start to unload, what's going to happen to this puppy? Because they need their cash to retire. That's another one of those black swan events that could happen. If they all panic and that whole generation that holds half or so of the market bails on it, what's that going to do? I don't know. All I know, I'd much rather be on the bear side of the market right now. And if I had long positions, long-term hold stocks, I would be protecting them a crazy amount. I would just be, because like I said, I think this is leg one of a downward bear market, possibly a major, major crash. So for what it's worth, again, listen, learn, educate yourself as much as you possibly can, and make decisions that make sense for you. But don't let your confirmation bias beat you up. So, holy cow, I think that's the longest I've ever gone. Sorry, Andrew. Thank you for hanging out and staying with me. So, yeah, happy trading. Hey, trading right now is happy for me. If you can't tell, I'm in a super good mood. You'll notice that if you pay attention to yourself, is when things are going your way, you're in a super good mood and everything's just spectacular. And then when they go against you, it's like, it's just one of those things, right? So anyway, all right, y'all have a wonderful weekend. So, I wouldn't say it's scary if you. It's not scary if you know what to do to either protect yourself or capitalize on the move. Actually, I think it's exciting because bear markets and market collapses and economic downturns are actually where the super wealthy people, that's where they make their money, is when markets crash. They're either prepared for it to snap up assets when it goes way down in value and the market panics, or they know how to take advantage of the bearish move, which is where I see myself. But then when the bearish move takes place and I capitalize on the downward move, then once things are done, now I can come in and snap up assets at a low price. When panic sets in, now I can snap them up. I can take all those profits I made on the downside and put them into assets that are likely to go back up in value at some point. So it's just learning to play both sides. It's not necessarily scary. It's seeing what is, recognizing what is, and just playing it. And even though I have my macro view, most of my trading is short term. So I still trade. I have bullish trades. I don't think I have any on. Well, I have one on gold right now, but I don't have any bullish trades on right now. And even though most of my trades have been bearish, I still have some bullish trades. I'm just leaning to the bearish side for periods like we have right now, right in front of us. So anyway, all right, I'll shut up. Thanks. Y'all have a wonderful weekend. We'll see you next time. God bless. Bye-bye.